Nigeria's banking industry is undergoing transformations as recapitalization targets align with the country's economic ambitions. This follows a recent call for banks to restructure Nigeria's 46 sectors into 14 sub-economies, enabling strategic long-term financing in areas like entertainment, hospitality, and mining. Tier 1 banks like GTCO, Zenith, and UBA are to lead with strong capital asset quality and digital transformation. We have the head of research services at Proshare, Tosin Ige, joining me now in the studio. It's a pleasure to have you join us.
Thank you for having me.
Right. I mean, the race is on, less than a year for recapitalization, and this is all expected to have them contribute to the goal of a $1 trillion economy. How well positioned are the banks right now as you see them, and what really is their contribution in terms of building and aligning with the national goal of $1 trillion economy?
Thank you very much for having me. As we said, the banking industry as a whole, their main purpose is actually to support the growth of the economy, not per se drive the economy. So they are to support the economy. And we know that from the call to actually recapitalize is also based in partly on the fact that banks need to be stronger in terms of capital to meet the projected $1 trillion economy. So on one hand, there is a need for banks to have enough capital buffer so that they may take up more risk in terms of the economy, maybe financing different targeted sectors. So they have that capital buffer for them to be able to manage any risks that will come from there. And on the other hand, with higher capital also, we see that the banks can also expand their tentacle. We could see them moving into digital space, increasing their digital presence. And on the other hand, we could see them setting up branches such that they could also cover areas that have been unbanked. So it's all in alignment with the $1 trillion economy. But of course, on its own, as a financial system, it is to increase their capital so that they have enough buffer in case of risk. Indeed,
indeed. And those risks, there have been conversations, of course, around the role that the banks are playing right now. SMEs, we know that they are the backbone of our economy and even achieving that $1 trillion. But then there are conversations that banks are not fully coming through in their commitments of giving them loans. They rather give those big loans to the bigger corporations than the SME who actually contribute largely. They may be many, they may not be as big, but contribute largely to that GDP.
So one thing we shouldn't forget is that banks are businesses. So they are there to make money. So and when you look at the way SMEs are structured currently in Nigeria, it may be difficult for SMEs to actually do a risk assessment on some of these SMEs. You know, banks are big on risk assessment before they lend. So they don't just lend their money to anyone, nook and cranny of the society. No, they actually do that risk assessment. That's why it seems that more of their lending is going to the big folks, because they have, those guys have credit history, and of course they could see the scale of their operation and the capacity to make return on that investment, and of course be able to pay down their loan. But you can say the same for SMEs. You know, there have been statistics that many SMEs fail in the first 5 years of their operation. So, and you want banks to lend to such a system, so they tend to pull back in that instance, because even for individual, one of the things we find out is that for some banks, they lend to individual, but it has a limit. Maybe they say 3 times your salaries or thereabout. So, but for SMEs, they can't even assess their earnings. You understand? Because of series of things that come to play. They're as small as micro scale economy. You see that those guys pay taxes that are not even formalized. You understand? So they, and of course, their entire businesses cannot even be valued. Maybe some of them are hiding one thing or the other, maybe because of the tax man. And as such, it makes it difficult, really, for the banks to do that assessment. So unless we formalize all the SMEs, banks may find it difficult to actually lend to these guys, because banks, as I said, are in the business of business. And so they have to make returns on their money, because it's also a risk for them. For them to, we did one of the things we did in our report is to look at the exposure of some of these banks. And we find out that some of them are exposed to, general commerce. You find it difficult to understand. Some of them are exposed to the oil and gas, exposed to the government. It was difficult to see any of them being exposed to the SMEs.
So there's a need, from what you're saying, there's a need for some sort of formalization of these MSMEs or SMEs in terms of corporate governance, bookkeeping, all those other deeds, and consistency as well. I mean, that's quite some insight there, and whether or not we see that, because that is how I believe we are going to get that $1 trillion economy and have them contribute. But I mean, coming to the report from Proshare, an interesting proposal was made there that the banks need to deconstruct Nigeria's 46 sectors into 14 sub-economies. Break this down for us. Okay,
so it's not only from the bank perspective. We're also looking at it from the economy. And what we're saying is that the 46 activity or sector, as you may call it, from the MBS, doesn't really allow for proper governance or accountability. You will notice that when you look at the books of banks, some of them will tell you that they are exposed to the upstream oil and gas, some of them just oil and gas. But when you look at that sector from the MBS classification, the oil refining is not part of the mining sector. There's a mining for where oil and gas is, and then there is the refining. So it's all scattered. And what we are saying is that let's streamline the sector such that when we have a particular sector, maybe energy, now there's an ecosystem. You'll be able to manage the ecosystem to say, if I invest in even renewable, what are the linkages to subsectors within that ecosystem? You get the point. Right. So if I invest in oil and gas, what's the implication for gas value chain? What's the implication for refiners in that industry? So that's why we say, let's streamline this thing. First, for the economy, it gives us a focused development effort. And then we'll also be able to optimize our resource allocation in that way, based on the ecosystem I talked about. And for the bank also, they will be able to prioritize that, the current administration is focusing on A, B, C sector. And so they will be able to also do their own assessment, risk assessment, and say, yes, these are sectors that we can also invest in. And so there will be that alignment for banks to actually support the growth of the economy. Because if we don't do that, what we'll see is that the government may have 3 priority areas, maybe the mining, the blue economy, and the rest, as their priority area to drive that $1 trillion economy. But on the other hand, you may find that the banks are leading to general commerce, to to sectors that are not in line with the priority of government. So that's why we're calling for that streamlining.
Deconstruction, right, quite the deconstruction. And you have mentioned the shiny sectors, oil and gas. But are there sectors, I mean, the subsectors that stand to benefit the most, that will give immediate, potential for bank financing?
So the main purpose of this is to say that we will not be able to say this sector will do better than this. Okay. But to say that we can actually grow holistically with all the sectors together. It's all, I as a bank A may decide to prioritize.
Equal growth across sectors?
Yes. I as bank A may decide to prioritize the blue economy. Okay. And then the bank B may decide to go for creative economy. Okay. You understand? So in that system, it's a joint growth. Rather than what we have in that the banks are having exposure to the oil and gas, maybe 50% exposure to the oil and gas, and as such, they are not able to lend to the other sector. Right. So that's why we're saying all this, if we do it, what we are expecting is that we have so much of the resources to grow. Let me take, for instance, the creative economy. Now, the creative economy is growing in scale and scope, but how much of it are we capturing in our GDP? Do you understand? Right. And our bank even lending to some of these guys. Some of them want to scale, but they are not having the support from the banking system. And when I started, I said, the bank may not lend to you because the sector is not formalized. And so they will find it difficult to lend to you. Right. We know of a number of filmmakers that want to also maybe set up a film village. Some of them have started. Now, you find out those who actually have film village are those who have been able to formalize their activities, the likes of, I think, Kuli Afolayan.
Right. So there's that emphasis again on formalizing.
So it's just an attempt to bring everything together. See, we believe that the era of taking things in isolation should have gone past. We need to be deliberate about our economy.
Yeah, and it's going to take a coordinated effort from the bank.
Coordinated effort, exactly, from the government and the bank.
Yeah, it'd be interesting if they can put competition aside and focus on, you know, building the economy. Yes, collaboration. But there's not much collaboration going on with the recapitalization exercise. Everybody's running their own race. Fidelity Bank, quite ambitious. From tier 1, they're aiming to go to tier 2. We know that they have...
No, from tier 2?
Tier 2, I beg your pardon. Yeah, sorry. They want to go up, not down. From tier 2 to tier 1, would you say they're being overambitious, especially considering the bottlenecks that what happened in Supreme Court recently?
Yes, so it's not really being overambitious. Even as an economy, we're ambitious with the $1 trillion economy, given that currently we're doing something around over $200 billion, and then we're looking at $1 trillion economy. So that's been ambitious. So from the economic perspective of this, being ambitious is good, basically. That's what I'm saying. And so, but in our report, we identify not just Fidelity, we identify 3 banks, like the likes of Fidelity, Stanbic IBTC, and FCMB, being those that may likely move into that cadre of tier 1 banks. And now this is because don't forget, we started with the fact that the traditional classification of tier 1 is to base it on asset size and of course capital, but we make it a more robust metrics to say, you don't just look at the assets. Let's deconstruct the capital, the share capital and the share premium. Let's also look at the asset quality. So you look at the MPLR, you look at the risk framework, the cost of risk, the cost to income ratio, the efficiency. So we base it on that. And based on our assessment, these guys are actually at the hem of moving into that category. Yes, some of them may be deficient in total assets. That's why they are still lower. But we see that they are actually moving in that target. But one thing that we also notice is that the recapitalization exercise currently going on, don't forget, it provides a base for all banks that are in the same license category. Now, the banks I mentioned, Fidelity is also has international authorization. Right. Like all the other tier 1s. The same thing with FCMB. They have international authorization. It's only Stanbic, because it's Stanbic Nigeria, so it has that national license. But we see that the trajectory at which these guys are growing, if they're able to raise that capital, which is the 500 billion naira that they set for their level, then we are seeing them moving in that category to be able to launch because we see what they are doing in terms of digital transformation, we see what they are doing in terms of efficiency, and so we're quite bullish that they will be able to move. All right. I mean, Fidelity, and amongst others, Fidelity was one of those that started the race early. So let's see if they finish well. Let's see if they finish well. So many shifts happening within the financial sector, the financial space, beyond just the banks. The fintechs are giving the traditional banks a run for their money. So how should the banks move at a time like this? What innovations are, on a daily? So, I mean, do you see the banks adjusting, or do you think that the fintechs will continue to press their neck? So, when the CBN called for this recapitalization, one of those things, one of those who started writing on this thing to preempt what's likely to be the game plan for some of this banks. And one of those things we had noticed is that a number of them will invest so much in technology. Right. We see them being big in technology. This is because, as you mentioned, the fintech, the neobanks are actually giving them a run for their money. But we've also looked at it holistically and see that what we pay the entire ecosystem is actually collaboration. Collaboration rather than competition. Now, don't forget, the fintechs, they are the front end. They have the customers. People like them for their efficiency, but at the back end, they are still dependent on the banking system. You understand? So they are still depending on the commercial banks and the rest. So because of that, we see that the collaboration is the main thing that will going forward, that will pay the entire ecosystem. Because these guys, the more you invest in technology, the more you are able also to domicile the customer and the experience within your system Yeah, we've seen some banks doing
Sounds
that.
like if you can't beat them, collaborate with them.
Exactly.
Interesting. Thank you very much for joining me, Tosin Ige, the Head of Research Services at Proshare. It's been a pleasure.
Thank you.